Good evening, everyone. My name is Shane Brewer, and I am the Education Coordinator for the Council. So this spring, we have an exciting program scheduled for all of our students and our educators. The Council will be hosting in-person student sessions before some select events throughout the semester. Students will have the opportunity to access our speakers, the ability to ask them questions about subject matter, their personal journeys, and the current issues that are important to them. Those events will take place on January 27th, February 24th, and March 9th. For more information about those events, please feel free to visit our website, www.wachouston.org. Now, about tonight's speaker. Christopher Leonard is an author and business reporter whose work has been featured in the New York Times, the Wall Street Journal, Fortune, Bloomberg Businessweek. He is a New York Times bestselling author of The Meat Racket and Kochland, which won the J. Anthony Lukas Work-in-Progress Award. Please help me welcome tonight's speaker, Mr. Christopher Leonard.
Thank you, Shane and Samaria and everyone at Amity Bank. It's wonderful to be back here again. And Chris, thank you so much for coming to Houston. And thank you all of you who came to be here in person. We're hopefully, as Omicron rates get better in the next few weeks, we're going to get back to more traditional audiences and bigger audiences. So thank you all very much for coming out. One thing I would just say is, first of all, I thoroughly enjoyed your book. For any of you who might be used to Fed speak or hearing a press conference from the chairman of the Fed or something like that, this book is not written in Fed speak. It is not written for a PhD in economics to read. This is written at a level for all of us to understand, because I think it's such an important issue for all of us to understand. I think the Fed plays a very important role in the U.S. economy. It has for over 100 years. But a lot of Americans really don't know exactly what it is that they do. And I think I would also say to any of you who may be thinking about it, this book is not written as a hit piece on the Fed. Chris, you dutifully point out the many important ways the Fed has done an awful lot to stabilize the economy when necessary. You're just more calling into question when certain practices, especially say quantitative easing and keeping interest rates very low or close to zero for very long, what are potential longer-term impacts. So, perhaps just to explain it, I think it's because it's an institution, it's a body that's somewhat a private organization, somewhat a public institution. Can you just very briefly talk about why it was the Fed was created? It's an example of why it was necessary. We had massive rates of bank panics. There were 3 bank panics in the 20 years before. It was founded in 1913, and why it was founded, and what was it supposed to be, and its key role in the U.S. economy.
Yeah, absolutely. That's great to walk through. And if I could also quickly, just honestly, truly thank each and every one of you for coming out tonight. This is the first live book event I've done in 2 years. And it's a really wonderful feeling to be back in a room with people and readers. And my previous book came out in 2019, and I was on the road for about 3 weeks away from my family and really cranky about it. And I just wanted to be home. And then I got way more than I wished for in terms of being confined to my home for months. And it gave me a new appreciation for this kind of thing. So really, thank you for coming out. I appreciate it. So the Fed. Why do we have the Fed? And I appreciate you pointing out, I don't see this as a hit piece. I'm not going to be coy. The subtitle of the book is How the Fed Broke the American Economy. I'll tell you how I kind of got to that point. But I try to quickly walk through the history of the central bank. And the way I see it is that if America could have operated without a central bank, we would have done it. This country was resistant to establishing a government-run central bank for decades. We, in fact, chartered and then revoked the charter of the central bank 2 times. And there's something about having a central bank that was kind of anathema to the American idea of distributed power and a federalist system. The worry was that if you created a central bank run by the government that could create money out of thin air, it would essentially displace the private banking system. And as we discovered, it's pretty hard to manage. an industrialized modern capitalist society without a central bank. From 1850 to 1913, it's so interesting in terms of, the cryptocurrency frenzy today. Back then, we literally had thousands of currencies in the United States. You could be in Illinois and get a currency, go to a hotel in Oregon and have to argue with the bank teller whether your currency was any good or not. It was a disaster. And this was a period that was defined by bank panics, as you said, long bouts of deflation, and there was actually a populist push from the grassroots to establish a central bank. And back then, in the early 1900s, the politics of creating currency, the politics of money, was a retail political issue. I mean, it was heated in the way that, gun control or pro-life issues might be heated today. It was something people debated about in the public square. William Jennings Bryan, the progressive, when he ran for president, probably said the most famous quote ever said about monetary policy when he said, "You shall not crucify mankind upon a cross of gold." That was a quote about monetary policy, and it riled the crowd up. And what the Senate and the president ended up doing in response to this political pressure was establishing this central bank called the Federal Reserve in 1913, and it had a currency, a national currency. That thing we call a dollar is really a Federal Reserve note when you look at the bottom of the bill. And so the Fed was charged with not only creating this currency, but managing it. And then the second key thing the Fed was created to do was to be what we call a lender of last resort. And the idea was that this bank, the Fed, would create dollars out of thin air and loan it to otherwise healthy banks in case there was a panic. So it could short-circuit bank panics. And I think you have to say, when you step back and look at it, we can talk a lot about the criticisms of the Fed, but it did these two jobs very, very well for decades. And that's why we created the Fed. Now, of course, what I talk about, which we'll get into, is things have changed a great deal since 2010.
And then just to get into the actual kind of nuts and bolts of the Fed, people hear about the FOMC, the Federal Open Market Committee. That is the group that meets every 6 weeks to largely, set the policies that will determine interest rates in the country. Can you talk about the composition of the Federal Market Open Committee and why it is that the hope was that because they are appointed, they are not elected, they're like the Supreme Court in that sense, that they would be separated and kind of devolved from politics. But maybe what are the actual working scenarios within the committee, and the fact that over decades we really got to a point where it was almost unanimity on most votes, or maybe it was 11-1, or perhaps occasionally 10-2. But can you talk about the actual deliberative process, in particular for the Open Market Committee? Yeah.
So how the Fed is structured and governed is really fascinating. It's like the Fed never met a problem it didn't want to overcomplicate. And its governing structure is exactly that way. So it's so interesting. When we built the central bank, it really is an American central bank. It's a system of 12 banks. It's a federated system, a lot like the states. So you've got these 12 regional banks, and then you've got a headquarters building in Washington, D.C., which isn't a bank, it's just an administrative office. And the administrative office is run by these 7 people called a board of governors that are appointed by the president and approved by the Senate. And then each regional bank has a president. Every 6 weeks, the leaders of the regional banks and the board of governors meet in Washington, D.C., and they sit on, it's not an exaggeration to say, they sit on the most powerful economic committee in the world, the Federal Open Markets Committee, or the FOMC. So when you hear that, the Fed raised interest rates today or the Fed cut rates today, it's a decision made by this deliberative body in D.C., and it has 12 voting members. And what's so interesting is the Fed was created to be insulated from democracy, to be insulated from the will of the voters, to be insulated from politicians. And the thinking there was the power to create money, which is the one superpower the Fed has. The Fed can create US dollars out of thin air. It's the only institution in the world that can do that. And to have that power is seductive. Country after country has been seduced by the power of running the printing presses. Because if you can just create money out of thin air, you can potentially avoid these very difficult decisions of a democracy of, you know, do you raise taxes? Do you cut spending? These bitter disputes. A lot of countries try to kind of do an end run around that by printing their way out of those problems. And so we decided we would create this committee of 12 people who won't be accountable to voters, and they'll be able to kind of operate in this high-minded way above the political fray and make these decisions about managing our currency. And, I guess to fast forward several decades, what we've seen is that the power in the Fed has become more and more and more concentrated in this body, to the point that it's almost not deliberative anymore, in the sense that, one of the themes of the book is that I think we can all acknowledge that our democratic institutions in America are dysfunctional and paralyzed to a very large degree, and particularly in Washington, D.C., when you look at Congress, when you look at the White House. Our democratically controlled mechanisms of dealing with big problems are kind of frozen, so we rely on these non-democratic institutions, whether it's the Supreme Court to arbitrate policy disputes, the military to handle foreign affairs, or in this case, the Federal Reserve and the FOMC to handle economic policy issues. We've given more and more power to the Fed, and within the Fed, power has concentrated more and more into the office of the Fed chairman. And so I was saying that the decisions made inside the FOMC hardly even seem deliberative anymore. With the Supreme Court, for example, you'll see a vote of, 4 to 5, or very close vote. In the Fed, it's almost always 12 to 0, 11 to 1. In a crazy scenario, it might be 10 to 2. And that's very intentional. It's a function of the Fed trying to appear infallible to the public. And I would argue really trying to disguise the fact that it's human beings making policy decisions, not just PhD economists solving math equations. But the Fed has really put a focus on this idea that they have full consensus. And of course, the book opens with the guy who tried to fight that and break it and failed. But the idea that there's consensus in the Fed is really important to how they govern and operate.
And maybe just, you talked about over the decades, especially probably the last 20, 30 years, the seminal role of the chairman and chairwoman, in the case of Janet Yellen, has become so vital. But in a bit of fairness, is it also realistic to say that unlike a vote by the Supreme Court, or unlike a close vote in Congress, that part of the belief or the origins of that is the need or the belief that we need to express to the American public that we are decisively unified in this decision, that we do not have uncertainty, so that it's even a hint of uncertainty coming from the Fed can have big economic repercussions.
That's the idea. And, this really, I think it's really fair to say this took a hold and was cemented under Alan Greenspan, who of course was like a long-serving mythical Fed chairman who really built this aura around himself as being like the oracle. And Greenspan really pushed forward this idea of having perfect consensus for exactly that reason you talked about, that, the Fed makes hugely consequential decisions that affect every single one of our lives. That's why I wrote this book. I mean, the Fed, it's more important today for our economic system than it's ever been. And I argue, obviously, it's been having pretty damaging effects on our overall economy. But the decisions it makes are so consequential, and Greenspan's argument was we need to present a united front. So first of all, the traders in the Wall Street community have confidence that we're going to follow through with what we do. Okay, now that would be fine, I suppose, if there was actual unanimity or consensus within the Fed. But, as an author, I kind of have the luxury of time. And I could go back and read through the transcripts of the actual debates inside the FOMC and inside this committee. They transcribe the debates and then release them after a delay of 5 years. And they quite brilliantly release the debates for an entire year on one day, which is, several hundred or thousands of pages of very dry material. So there might be like one quick news story about it, and public attention just kind of moves on. But when you go back and look at these debates, you see the Fed isn't some infallible group of Olympian-level PhD people who are just solving equations. They're human beings operating on hunches. And I'll give one small example. In 2012, Chairman Ben Bernanke was making a very consequential policy decision to do a round of money printing called Quantitative Easing, the largest ever to that point in history. In public, he was saying that programs like this, while they're experimental, we understand very well how they work and they've been effective. Inside the FOMC, he was saying if we do this, it's going to be, quote, a shot in the proverbial dark. And there was a lot of dissent and dissension and dispute inside the FOMC about it. There were people, including the current chairman, Jay Powell, who said this is dangerous. We're getting short-term gains. We're building up long-term risks. I show really through interviewing the people who are involved on the record, looking at the transcripts and the media coverage, that a lot of politicking goes on. Ben Bernanke would pick one or two governors, work with them one-on-one, and shape the outcome of the meeting. So this idea that there's total consensus is misleading. There are policy disputes, and the real fact is the Fed is feeling its way through a dark room right now. Trying to figure out what to do.
And you touched upon it earlier, but just to maybe highlight that if there is a degree of reluctance to take on such a large role, in just most basic terms, there's fiscal policy and monetary policy. The United States fiscal policy was typically, you hoped Congress or whatever state or level governments would do a reasonable job with regards to setting budgets, setting taxes, collecting revenues. But since 2008, and especially 2010, the complete dysfunction in Congress has taken away a lot of that. The Tea Party, who basically would say the only appropriate policy is to cut taxes, cut regulations, and cut spending. Nothing else would apply. Our continuing dysfunction in Congress, is that part of what's forced the Fed to perhaps act because Congress refuses to do so? And maybe they feel if we don't act, no one will act?
Yes. Big question. Which brings us up to the year of 2010 when this book starts. This book starts on November 3rd, 2010. And this gets to why I wrote the book and why I flew to Houston, Texas to talk to you about it, is what has happened over the last decade. I can't overstate how unprecedented it has been. Okay, we're all very familiar with the global financial crisis of 2008, a global worldwide financial panic with potentially devastating effects. The Fed stepped in and bailed out the banking system. It took extraordinary measures, in many ways, as it was built to do. But the story I'm trying to tell is what happened afterwards, starting in 2010, when the economy was slowly recovering, sort of crawling out of the hole of the financial crisis. On November 2nd, the Tea Party was elected, took power in the House of Representatives, and really at that point, our fiscal authorities, Congress, shuts down. They move to the sidelines. The action really stops in Congress. And that's when the Fed steps forward and breaks the graph of history and pushes us into a new era by engaging in this program called Quantitative Easing. And here's what's so extraordinary about it. At the time, the Fed had used what many people at the time thought was the limit of its powers. The Fed had not just bailed out the banks, but they had pushed interest rates to zero. Okay, it was thought you couldn't go lower than zero at the time. Interest rates had brushed up against zero a couple times in the past. The Fed had kept them there for months after the crash of 2009, and then a year, which had never been done. And Ben Bernanke, the chairman at the time, was saying, we need to go further. We're going to push further. We're going to go below zero. And we're going to do it through this thing called quantitative easing, which has never really been done in this way. There was a round of quantitative easing in the midst of the crisis. We can talk about it. This was different. This was like, we're going to make ourselves the central engine of economic growth in America, not bailing out banks in a crisis, but driving growth ourselves. And quantitative easing is really simple. The Fed creates dollars by buying things on Wall Street, okay? There's this group of 24 special financial institutions called primary dealers. They're the folks you think about, JP Morgan, Goldman Sachs, Wells Fargo. These institutions can sell things directly to the Fed. So, I've been on the Fed's trading floor in New York City, and that's where these traders at the Fed will call up JP Morgan and say, hey, we'd love to buy $8 billion worth of Treasury bonds from you. JP Morgan says, okay, and they sell those bonds to the Fed. And the Fed says, hey, look in your special reserve account at the Federal Reserve. Boom, $8 billion just appeared out of thin air. The Fed created it. With quantitative easing, the Fed replicates this transaction again and again and again until it has created hundreds of billions of new dollars inside these bank accounts on Wall Street. That's how the Fed pushed interest rates effectively below zero in 2010. Let me put it in perspective. In the first century of its existence, the Fed slowly and gradually increased the monetary base, as we call it, or the total pool of original Fed dollars that it can create. It gradually increased that to $900 billion. Okay, so that's like $1 trillion of new money created over a century. Between 2008 and 2014, the Fed printed $3.5 trillion new dollars. 350 years worth of money printing in those few short years. So the graph of money creation gradually increases and then spikes up. And now this is the decade of the 2010s. This is the era of hyper easy money. As it would happen, interest rates are kept at zero for 7 years. Again, can't overstate how extraordinary that is historically. Pinned at zero for 7 years while you're pumping trillions of dollars into the banking system. That's what created the massive distortions in our economy that I'm talking about in this book. And that's why the decade of the 2010s is so different from the decades that preceded it.
And I think maybe to highlight it more, for one thing, qualitative easing, that doesn't mean much to most people. Easing implies to me a verb, something that's changing, that's going to maybe go away after a while, which had lasted for 7 years. The Wall Street, they use terms like ZIRP, zero interest rate policy. Maybe that would have been better for the public to understand what was going on. But can you talk about how, in qualitative easing, QE, it worked. It did exactly what the Fed wanted it to do. It achieved its goals. It drove up, and stabilized the stock market. It drove up asset prices. It created massive asset inflation and prevented price inflation, at least perhaps until now. But can you talk about what the results were when we have such a disparate separation between what percentage of people own major assets in the United States and say the bottom half of the United States who owns very little, and how those policies have just further broken the divide between the haves and the have-nots?
So much to unpack there. You're going to discover, I've been unpleasant to be around for the past couple of years because I just talk about this stuff. Like, you really are getting me going. So first of all, your point that this thing is called quantitative easing is very important. The Fed, there's a whole chapter in the book called Fed Speak about the way the Fed has very intentionally cloaked its policies in needless complexity. We could sit here and talk about, today the Fed is talking about tapering large-scale asset purchases, which will cause yields to rise in the long term, which might affect the yield curve. It means nothing, like not even English. But in reality, quantitative easing is a relatively simple concept. And I had the benefit of talking to these kind of two spheres of people that talk about these things. One sphere would be the PhD economists and theorists who dominate the Federal Reserve governing structure. The folks like Ben Bernanke, the staffers who work for him, who use terms like large-scale asset purchases and who operate on these theories of here's what will happen if we do this. But then you've got this other sphere of people who are these people who operate in the wake of the Fed's actions. These are the traders on Wall Street. These are the people that operate the private equity firms. These are the people that operate the hedge funds, the stock speculators, the securitizers at Credit Suisse who package leveraged loans and sell them on Wall Street. These folks are relatively unsentimental when they describe what the Fed is doing. They are not operating on big theories about what will happen. They're operating on the reality. And the reality they describe is pretty stark. And it illuminates what you just said, okay? This program worked as the Fed intended. But I want to point out how it was intended to work, okay? The Fed knew that if it was going to do this, if it was going to print this money on an extraordinary scale, it was going to affect the economy in three key ways, okay? Remember, the Fed can only create money. It can't build a bridge, it can't build a factory, it can't put a shovel in anybody's hand, it can't teach a kid. All it can do is create money on Wall Street. And when it did that, it had three mechanisms through which it would affect the economy. One was it would devalue the dollar, which was, the hope was that it would stimulate U.S. exports. Secondly, it was going to create more cheap debt and stimulate borrowing and speculation on Wall Street. So it was going to bring down the price of credit in hopes of, stimulating more loans. But third, as you pointed out, the Fed knew that this would stoke asset prices. When you put this money into Wall Street, that money is going to instantly go out and search for a place to invest itself. It's like water looking for soil to seep into. It's searching for profit or searching for yield, as they say. So all of these new dollars went chasing assets. And that's why you see these asset prices start to rise as the Fed is doing it. The money is looking for anything it can buy. Tesla stock, commercial mortgage-backed securities, leveraged loans that are packaged into these securitized products called collateralized loan obligations. All this new money is chasing these investments and driving up the price of those investments. Because, incidentally, it's worth pointing out that this money was coming in at a moment when interest rates were pinned at zero. So you really can't earn anything saving money. It's got to push out into the economy. And this is another one of those terms you see every day in Bloomberg, in the Wall Street Journal, the search for yield, the search for yield. It's just a way of saying that the Fed was incentivizing to the level of almost coercing Wall Street to push money out into more risky lending, into more debt, and into more speculation. And that's exactly what we saw. And yes, it did work as intended. Stock market prices doubled, more than doubled during the decade that we're talking about. The level of corporate debt rose from $6 trillion to a record $10 trillion during the decade we're talking about. The market for collateralized loan obligations took off. At the same time, overall economic growth was weak, productivity growth was weak, and wages were stagnant. This was the economy of the 2010s. I call it kind of like a funhouse mirror economy. You see record-breaking asset prices, stock market breaking records every day. The news on CNBC sounds great, but most of America is still treading water. And to the point you mentioned, I talk about the Fed widening the gap, widening income inequality, widening the gap between not just the rich and the poor, but just the very, very rich and everybody else. And that's just a natural consequence of a policy that tries to create growth through stoking asset prices. It's a cliche to talk about a 1%, but 1% of the U.S. population owns 40% of all the assets in the country. The bottom half of Americans, what is that, like 180 million people-ish, ballpark? The bottom half of Americans own 7% of the assets. So the Fed's asset-first policy dramatically widened the gap between the very rich and everybody else.
And maybe just to put it in more kind of personal terms, on its whole, the Fed absolutely committed to and kept its goal of keeping inflation pegged about or below 2%, keeping price inflation down. But in terms of asset inflation, are we perhaps not thinking about some of the longer term negatives to it, especially say looking at something like the housing market? If you're a young couple in your late 20s, early 30s, how do you afford a house now? Or I'm not sure what it's like, where you live, but here in Texas, we have very high property taxes, and those are based upon the value assessed for your house. So if you're coming up to, say, retirement age, and you happen to be in a nice neighborhood that you like, and you've lived in for 20, 30 years, the fact that your house has tripled in value means your taxes have tripled. And once you retire, you may not, that's a primary reason why a lot of people in Houston and nice parts of Houston who retire, why they actually leave is because the property taxes. What are perhaps the negatives to that huge growth in asset prices that we haven't considered?
Key negatives, I would say, unless you run a hedge fund like BlackRock. But here's what I see as the negative. So really the main character of the book is that guy I mentioned earlier, Thomas Honig, who was president of the Kansas City Federal Reserve Bank. In 2010, he voted no at every single Fed meeting that year. No, trying to stop these policies. And Honig kind of got remembered by history as being a sort of a crank and a dissident and an inflation hawk. In reality, I was really shocked when I went back and looked at the record and saw that this guy was making a very nuanced argument as to why the Fed should not do this. And the argument revolved almost entirely around asset inflation, which you just described. Now, it's not coincidental that at the time, Thomas Honig was the longest-serving member on the FOMC. He had been at the Fed for 32 years. He'd been a voting member on the FOMC since 1991. He had seen some things. And one of the key things he saw firsthand when he was a bank examiner in Kansas City in the 70s was he had seen the out-of-control inflation, what we call the Great Inflation of the 1970s. The chapter about that, I actually call it the Great Inflation, parentheses with an S, because it was really the Great Inflations of the 1970s. During that decade, the Fed kept interest rates too low for too long, and it stoked price inflation, which we're all very familiar with. That's when the gas prices jump, meat prices rise, and oil prices rise. That's the kind of inflation we're very familiar with. But there's this other kind, which the former Fed Chairman Paul Volcker called the unruly cousin of price inflation, and that's asset inflation. That's when the stock market rises. And those two things happen in tandem. Now, what is so strange and unusual about the decade of the 2010s, we can talk about it, but we saw runaway, out-of-control asset inflation during this decade, as designed by quantitative easing, but we never really saw price inflation over the last decade, which is fascinating. And I'll tell you who has no idea why we didn't see price inflation is the Federal Reserve Bank. They kept expecting price inflation to arise and rise higher than the Fed's 2% target. And I've read their internal forecasts. They were consistently wrong on that point. And they couldn't figure out why we didn't see price inflation. We can talk about why it didn't happen. I think it probably has to do with a global supply chain creating kind of a deflationary force on prices, but it never happened. Crucially, because price inflation never reared its ugly head over the last decade, it is a fact that the Fed felt very comfortable to continue these hyper easy money policies, what the Wall Street guys call ZIRP, zero interest rate policy, which is QE mixed with 0% interest rates. The Fed felt absolutely comfortable to move forward with these programs and stoke asset prices as long as they didn't see price inflation. But as you point out, that has a real world effect, and I would say it's twofold. First of all, in many communities around the country, housing has simply left the capability of people to buy a house. I mean, as you just talked about, it's not just folks moving out of the house they've lived in for decades because the taxes have gotten so high. It's young couples, who might have in the past been able to buy a house right after they got married, can't do it anymore, particularly in urban areas. The Fed is that invisible force that is driving up home prices by double digits because it's keeping interest rates low, and now through quantitative easing, it's directly buying home loans. So it's stoking that market. Secondly, maybe more importantly, this is where the rubber meets the road. I think this is probably instability. This is the thing that Tom Honig kept arguing. He said, if we're going to draw down the unemployment rate slightly by stoking asset prices, it could be seen as a good thing in the short term. You know, you get to go out there and say, hey, we just created 750,000 jobs through quantitative easing. But the problem is you're stoking asset bubbles that will eventually crash. And then unemployment is going to rise to 10%. So over the long term, was your policy beneficial? Now, I'd like to point out, it wasn't just Tom Honig making these arguments. There were 3 or 4 other members of the FOMC making those arguments in 2010. In 2012, the Fed got a new governor named Jay Powell, who became chairman. He was arguing in stark terms at that time that we were piling up these long-term risks by stoking asset prices. And Powell himself said, if we keep doing this, we are going to have a, quote, large and dynamic event, which is just sort of polite speak for a financial market crash. He said, we're going to have a large and dynamic event we're not going to be able to handle. And that's exactly what we saw happen in March of 2020, and I can walk through that. But to emphasize the point, the problem with stoking asset prices to this level is that it can't go on indefinitely. Life would be so great if asset bubbles would just stay inflated forever. But the tragic reality is that the price of an asset inevitably converges with its real value. That's what's destroyed every asset bubble in history, from tulips to Florida swampland to home loans to .com prices to, I dare say today, collateralized loan obligations and corporate debt. So that's the problem, is you create financial instability.
And can you talk about just, I know it's a tough topic to, it's years of policy to go over, but most people would absolutely agree, and the Fed should get huge credit for what it did in 2008 for getting us out of that recession, but would probably surprise people, and you go through it in your book. Why was it that the Fed, and before he was chairman, you noted Jerome Powell himself was hesitant, warning of these risks? Why was it when so many of the other economic indicators were indicating where the economy was recovering, that we're no longer in an economic crisis of 2008, 2009, why was quantitative easing and these zero interest rates kept? Why was it kept for so long? Or is some of it just because it's so hard once you start something like that, it's so hard to stop it without perhaps causing another panic? Why was it kept?
Okay, so this is a great debate. And I think if the advocates of this program were sitting here, they would say, well, what would you do in 2010? Are you saying the Fed should have sat on its hands during that time? Because, the economy was grim and ugly in 2010. It was a horrible time. Unemployment was over 9%. Economic growth was weak and slow, okay? And so there's a real argument to be made that you need to do something in the face of that. And the people on the FOMC aren't blind. It was very clear when the Tea Party took control of Congress, the Tea Party ran on a policy of shutting down federal action. They were a party that didn't want to see more fiscal action. Okay. What's interesting is that nobody knew better than Ben Bernanke that after the crash of 2008, the experts knew it was going to be a long road out. An economic recovery after a financial crisis is not like an economic recovery after a normal recession. All the experts say, their forecasts are in the book, that it was going to take years to get back to full employment. That was the harsh hangover reality of the crash of 2008-09. It shouldn't have been a surprise to anybody. Bernanke knew this. And what Tom Honig was arguing at the time was, look, we're not going to hike interest rates. We're not going to create a tight money environment. But we need to restrain ourselves at this moment. We need to let the economy slowly grow on its own without injecting billions of dollars into Wall Street, so that it can find this new equilibrium. Because what Honig was saying is that if you do this, if you start pumping this money, you're never going to be able to stop. And he was exactly right on that point. So that's the argument. And I'll tell you what, it's not a great bumper sticker like restraint. It doesn't capture the imagination. It doesn't help you sell memoirs. But I really do think at the end of the day, particularly in the realm of monetary policy, restraint turned out to be an extremely important quality. we had the gold standard for decades to impose restraint on money. The gold standard didn't really work. It's kind of a crazy system. We can talk about it. So we created the Fed and human beings to try to show some restraint. And that's why people love these new cryptocurrency coins, is that they have restraint that's imposed by math or by an algorithm. There will only be so many Bitcoins. The great difficulty in managing money is having a sense of discipline over it. And I think, listen, the argument here is, of course, it was an all-hands-on-deck emergency in 2010. The United States had a lot of problems it had to deal with. But I would argue that a policy of pumping money into the banking system, stoking up asset prices, and trying to encourage cheap debt and risky lending wasn't good policy. And they knew at the time that that's how this policy was going to work. And I think they fell into a trap that we see in institutions again and again, which is to appear that you are doing something, appear that you are taking action, appear that you are confronting the enemy, if you will. It's a lot more heroic than saying we are going to show some restraint at the moment. So that's how I respond to that.
And in the book, that kind of maybe brings it back to Texas a bit. You note that the term "too big to fail" didn't start in 2008 talking about certain companies or certain large private financial institutions or banks. The term comes from a congressman using it in the 1980s in reference to Continental Bank, a large Midwestern bank that was extremely exposed and over-leveraged to loans, a lot of them made for Texas and Oklahoma, and then the oil market collapsed. So the concept of too big to fail has been around for decades. But where are we now? A lot of those same companies or banks or financial institutions that were supposedly too big to fail in 2008 are bigger. Banking system has been consolidated. Many of those banks have bought each other out, and there are fewer major banks left. Thousands of small community banks are gone. What are you concerned about with regards to a few key too big to fail institutions? It would be a private bank or a financial institution getting in trouble again.
In all sincerity, I don't know where to start when you ask me where I'm concerned about this system as it exists today, particularly with the too big to fail banks. You're pointing out something really important. The inflations of the 1970s created a banking crisis in the early 80s that was the worst since the Great Depression. And that really is where this idea of a bank being too big to fail came from, with Continental Bank in Illinois. And the Fed has made a very conscious decision to enforce that policy idea that the Fed will be there to bail out institutions that pose systemic risk. It's kind of a wonky way to say it, but on Wall Street they talk about it as the so-called Fed put. A put is a financial contract whereby you promise to buy something at a certain price. It puts a floor in the market. And everybody on Wall Street knows that there's a so-called Fed put. They used to call it the Greenspan put, then the Bernanke put, the Yellen put, the Powell put. And it's this idea that if asset prices ever really start to fall in a real way, the Fed is going to step in and buy and cushion the companies that made the risky bets in the first place. So the status of being too big to fail is a definition that keeps getting larger and larger and encompassing more and more parts of our financial system. And I'll give a very specific example of that. I chart in the book how during the decade of the 2010s, these ZIRP policies created massive fragility in our financial systems by stoking up these asset bubbles. It's fascinating, to be honest. The history from 2018 to the first COVID case in 2020, the Fed was trying to pull back on these easy money policies, and it simply couldn't. Every time it started, markets would start to crash, and the Fed would stop and get back in and buy and pump more money into Wall Street. And this was the economic system that collided with COVID in March of 2020. And of course, COVID was an unprecedented economic catastrophe globally. We've never had a situation like this where the whole global economy had to simultaneously shut down and then figure out how to restart. Okay, it was bad. But it's it's very important that the financial system that COVID hit in the United States it's what the Wall Street types call priced to perfection. Stock markets were bubbling at extraordinarily high levels. As I've mentioned many times, corporate debt issuance was at record levels, and these loans were risky loans. I don't have time to get into it here, but when a bank borrows money through a corporate loan, it's not like a credit card debt that you pay off every month. You have to pay off the entire amount of the loan at the end of it, which means these companies are forced to constantly resell their debt, and if interest rates ever rise, they're toast. This was a fragile economic system, and we saw a financial crisis in March of 2020 that was worse than the crisis of 2008. The bill was coming due, whatever cliche you want to use, the chickens were coming home to roost, and all of these debt structures that the Fed had stoked up through quantitative easing began to collapse. And the Fed responded by printing 300 years worth of money in a matter of months this time. $2.9 trillion just right off the bat pumped into Wall Street. And critically, the Fed stepped in and said it was going to buy varieties of products it had never bought before. It was going to directly purchase corporate junk debt. It was going to directly purchase securitized junk debt called a collateralized loan obligation. The Fed expanded the Fed put to a breathtaking level, to whereby these real gritty bond trader types like this guy, Scott Minerd, who I quote in the book, they just couldn't believe what they were seeing, that the Fed was going to step in and buy corporate junk debt. This guy told me, now when people extend a leveraged loan, they don't care about the creditworthiness of the company anymore. They just care about whether or not the Fed will buy it when it goes bust. That's what's now determining these debt markets. So we're in a position now. Sorry, it's a rather long-winded answer to your question, but where are we now with this idea of these too big to fail banks and the Fed's safety net? The safety net, it hasn't just gotten much, much larger over the last decade. It's like the promise of the safety net has become infinite. The institutions on Wall Street see that the Fed will step in to bail them out. And so therefore they are much more likely, corporate debt has hit new records. The stock market was breaking new records until recently. And, it's well known that the banks that were too big to fail that led to the crash of 2008 are now even larger and less able to fail. And they've been joined in the market by the shadow banking system, like the private equity firms and the hedge funds. So there you have it. I mean, it's a situation where these giant entities on Wall Street have so much power, and they're truly not worried at all, I think, about a crash, because they make money on the way up through fees. They get bailed out at the end when things crash, and then they can repeat afterwards. And the rest of us, that population of Americans who kind of makes their living by gathering a paycheck rather than owning assets, face the ensuing damage and the fallout from these periodic crashes.
All right, I just want to go through some great questions from the audience. Mike asks, why is money creation with quantitative easing worse than that of monetary creation through servicing of government debt from deficit spending?
Such a great question. So, the United States Treasury pays for its activities by issuing corporate, I'm collecting taxes, and then paying for the rest of it by issuing debt. These two systems are very tightly intertwined because right now one of the biggest buyers of United States debt or Treasury bills is the Federal Reserve. It buys it in a circuitous route through the Wall Street primary dealers. So they're different in the sense that the Treasury is doing actual fiscal work. It's putting money into people's pockets. It's paying for Medicare. It's building bridges. It's issuing that through debt. The separate system of monetary policy is that the Fed is creating U.S. dollars inside Wall Street. And again, they're interlinked because the Fed is often printing those dollars to buy U.S. debt. So it's an unsatisfying answer, but I'd say that's the key difference. Is one is just creating dollars, and then the other is creating government debt. Okay.
And two questions, just since they're somewhat related to the time period we're talking about right now and policies, I might just combine them. Bill asked, was COVID a black swan? Would the March 2020 crash have occurred without COVID? And then related to that, someone asks, with regards to quantitative easing, can the Fed find a way out, or at least stomach a reverse? A reverse will cause short-term instability and volatility, but short-term reactionary policies have long-term consequences, which isn't a good system either. I suppose, yeah, do you think without COVID we might have had an asset bubble? And I suppose more broadly, what are we looking at going forward?
So fascinating. COVID was a black swan, but there's, okay. First of all, really, I document that the system was fragile and falling apart in the autumn of 2019. There's a crazy story in there about a financial panic not many people heard about in the so-called repo markets. The Fed had to print $400 billion in September of 2019 just to keep the system functioning. I call it the bailout nobody ever heard of. So it's not like the system was just swimming along fine. And yes, COVID hit as a black swan, but I want to point out, I've got this great article about when they were extending all these leveraged loans and packaging them into these securitized things that were just like the home loan securitized products and selling them. Everybody was saying, hey, these things are going to be safe. Yeah, it's kind of risky debt, but we've diversified, and these things couldn't go bust unless somehow you had something happen that would stop sales across all industries at one time. Well, that happened in March of 2020. And the point is, black swans exist, and when you build risky debt products, there's always going to be something to puncture it. But yes, COVID was a precipitating event that created the crash of 2020, but something was going to happen. I mean, I am of the mindset that asset bubbles can't stay inflated forever. Can the Fed pull back? We are just in such an interesting moment right now. When all these debates were happening at the beginning of the book, the Fed's balance sheet was worth about $2 trillion, meaning that kind of reflects how much money the Fed had printed. It was $900 billion before the 2008 crash, $2 trillion afterwards, big deal. It's north of $8 trillion right now. It is astounding the level of intervention that the Federal Reserve has made. Unprecedented. Now, this would be absolutely fine and nothing to worry about if the Fed had a nice runway of 5 to 7 or 10 years to kind of unwind these easy money policies in a calm, predictable, incremental fashion. Tragically, it seems the Fed will not have the luxury of time because price inflation now is rising. Price inflation is hot, as they say. It's rising at the highest level since the early 1980s, and it appears to be endurable. Okay, we're all in uncharted waters, but price inflation does not appear that it's going to go away anytime soon. This is like a gun to the head of the Fed. It is going to have to tighten the money supply if it wants to fight inflation. But to tighten the money supply necessarily just because of math, means that the investment community will begin to withdraw their assets from these risk assets. They're going to take that money out of those leveraged loans that they bought in the 0% interest rate world. A lot of stuff that made sense in the ZIRP world, quantitative easing, 0% interest rates, is not going to make sense in a world where short-term interest rates are 2.5 or 3%, and the longer-term interest rates are even higher than that. Long-term interest rates are kind of like Wall Street's savings account. And if Wall Street realizes they can put their money back in the savings account and take it out of this like wild, fracking junk debt company that they just, I guess I shouldn't bash on fracking in Houston, Texas.
It's all right.
It's well stated that a lot of these fracking companies had over-optimistic projections, but none of the ones that might be present here, definitely not. So the risk assets will be withdrawn from, okay? They're gonna, the tide will come in, and we will see a downward adjustment in asset prices, which sometimes can be known as a crash. So there's a tug of war going on right now. Wall Street doesn't really take the Fed seriously if the Fed's going to hike rates. The Fed promises in all solemnity that they're serious. They have shown in the past that they will not be serious. Are they going to, it's anybody's guess what's going to happen now, but the one dynamic that is 100% clear is that the Fed cannot tighten without creating massive volatility in the markets that the Fed itself has created. The Fed itself has stoked these asset bubbles.
And lastly, a very interesting question, last question from the audience, and before we wrap it up. Will the Chinese push us out of being the world's reserve currency?
Oh man, that is the multi-trillion-dollar question. Being a global reserve currency is such a remarkable position of power that the United States has had since World War II. If we ever lose that position, it is going to, I'm sorry it sounds hyperbolic. It'll change the American way of life as we know it, because we will be subject to market forces on our currency. Because as it stands right now, when everything gets bad, people rush to the dollar. And we benefit from that. Now, will the Chinese currency become the next reserve currency? Will Bitcoin take over? I think it's safe to say that, right now, there's no clear, viable competitor to the United States dollar as a reserve currency. The euro doesn't seem to cut it. They all have much smaller market share, if you will, than the United States dollar. We still have a pretty secure position, but I do want to say this. I really do. There is a certain red line whereby the United States can issue so much debt that global appetite for that debt kind of hits its limit. And we have to pay higher interest rates to attract people to loan us money. And people might even lose faith in the United States currency, and there could be a change. We might, China might not become the global reserve currency, but we could lose our status as the preeminent reserve currency. Where that red line is, nobody knows. Are we 20 years away from that? 10 years, 5 years? It's like we don't know where the red line is, but we just seem determined to find out. Even before COVID, the United States government was running at a $1 trillion deficit annually. And these were the good times when the economy is good. And cards on the table. I'm a liberal person. And I have to admit that I believe in the power of government to do good, social safety net, and all the rest of it. However, economic reality matters, and these debt markets matter, and there might come a point where we do sort of face the threshold of the stability of the United States dollar, and I feel very confident in saying that's not a place we even want to think about going to.
Not the happiest place to leave it. But it's a complicated, difficult subject, but an important subject. And I really, highly recommend, the Lord's Visa money. We have it outside if you want to get one, and Chris will kind of stay around to sign them. But, thank you. This is truly, I think, an important book for just the general average American public to really think about what is the role of the Federal Reserve, especially in light of the fact that Congress, whether it be Democrats or Republicans, have largely stepped back from any kind of reasonable or long-term fiscal responsibility or fiscal policies. So will you all please join me, everyone at home too as well, in thanking Chris Leonard. We look forward to seeing you all next week. Thank you.
Thanks for coming out, everybody. I appreciate it. The book does not have a happy ending.